Hello friends, welcome to NJ Education. Learning should never be restricted to a single domain, and so is our channel. In this set of playlist, we will be covering several topics on accounting. The video is helpful to everyone though, but specifically it will assist students aspiring for CA Foundation course. This video is about Unit 1 Meaning and Scope of Accounting. We will be covering all the below listed points throughout the video. Let us start with definition of accounting. As per definition given by Committee on Terminology set up by American Institute of Certified Public Accountants, accounting is an art of recording, classifying and summarizing in a significant manner and in terms of money, transactions and events which are in part at least of a financial character and interpreting the result thereof. Let us break this definition in parts and try to understand it. First of all, it's an art of recording. That is, we record transactions, events, and result from those transactions via accounting entries. Classifying. We classify the transactions and entries in groups of similar transactions such as expenses, income, asset, and liabilities. And summarizing. There are numerous transactions occurring on daily basis in a business. It is really difficult to interpret and come to a conclusion unless all the transactions are summarized in a presentable format. Hence, accounting is an art of summarizing the transactions. The best example can be of a trial balance. A trial balance is a summary of closing balances of all the ledgers in a significant manner and in terms of money. So, we record, classify, and summarize transactions and events which are of monetary nature. Transactions and events. What are transactions and events? So, understand, transactions are the economic activities undertaken, and events are the result of these economic activities. Let us take an example to understand this. I set up a Kirana store in the month of May 2020. I invested rupees 1 lakh as an initial capital. To start the business, I took a shop on rent of rupees 5,000 per month. I bought groceries worth rupees 60,000. I have a balance cash in hand of rupees 35,000. At the end of the month, I noted that I have sold groceries for rupees 80,000 and have stock in hand of groceries worth rupees 50,000 in my store. I made further calculations to analyze the result of my business. So I sold groceries of worth 80,000 and have stock in hand of rupees 15,000. I have paid rent of rupees 5,000 and purchased groceries of 60,000. So the surplus of all the transactions is rupees 30,000. In given example, we can observe that sale or purchase of groceries and payment of rent are the economic activities undertaken, and hence these are transactions, whereas balance stock in hand, cash in hand, and surplus are the results out of the economic activity, and hence these are events. Let's go back to the definition. So, accounting is an art of recording, classifying, and summarizing in a significant manner and in terms of money, transactions, and events which are, in part, at least, of a financial character. What it means is that the transactions and events need not be entirely monetary. For example, if I purchase a television in exchange of old television and cash of rupees 20,000, it can be accounted as a transaction and interpreting the result thereof. So, accounting is not only recording, classifying, and summarizing of transactions, but also interpreting the result of these transactions. However, with the evolution of business and stakeholders gaining more interest in the business, the accounting does not end up only with interpreting the result of business, and thus communication of the results to the stakeholders also gain importance in current times. Thus, accounting may be defined as the process of recording, classifying, summarizing, analyzing, and interpreting the financial transactions and communicating the results thereof to the persons interested in such information. Based on the definition, procedure of accounting can be divided into following two categories. First is generating financial information, and next, using the financial information. Generating financial information includes recording all business transactions are evidenced by some or the other supporting documents. These business transactions are recorded in book called journal. Classifying. As discussed in initial segment of the video, transactions are grouped based on the nature. The book which contains this classified information is called ledger. Summarizing. The information classified in ledgers are summarized so as to make the information presentable. These information can be summarized and presented in the form of trial balance, cash flow statement, profit and loss account, balance sheet, and so on. Analyzing. The information presented is useless unless it is analyzed and used in informed manner. For example, investors use ratio analysis to analyze the business before they make any decision regarding investment in a business. Interpreting. It is concerned with explaining the meaning and significance of the relationship as is established by analysis of the accounting data. Financial statements should explain not only what has happened but also why it happened and what is likely to happen under specified conditions. Communicating. It refers to transmission of summarized, analyzed, and interpreted information to the end users to enable them make rational decisions. Using the financial information. Gone are the days when financial information were useful only for proprietors or owner of the business. Nowadays, these information are useful for investors, lenders, employees, suppliers, customers, government, and the public at large. The owners, management, known as internal users, use the information in analytical manner to take valuable decisions for the business. Hence, the financial information presented to them are more detailed compared to the information presented to external users. We will now discuss objectives of accounting. First is systematic recording of transactions. Basic objective of accounting is to systematically record financial aspect of business transactions. These recorded transactions are then classified and summarized logically for preparation of financial statement and its analysis and interpretation. Ascertainment of results of above recorded transactions. Various reports and statements are prepared using the transactions recorded to ascertain the result of business, such as cash flow statement is prepared to know the inflow, outflow, and status of cash in hand. Profit and loss account is prepared to ascertain the profitability of business organization, and so on. Ascertainment of the financial position of business. Any stakeholders of the business is not only interested in profit and loss of business, but also the financial position, that is, what business owns and what it owes to others. In other words, the asset and liability position of an organization. Stakeholders refer to the balance sheet as on the date to know the financial position of business, providing information to the users for rational decision making. Accounting aims to meet the information needs of decision maker by communicating the financial result of an organization and thus aids in decision making. To know the solvency position. Accounting not only helps in understanding the financial position, but also it gives information about liquidity position, that is, firm's ability to meet its liabilities in short run, and solvency position, that is, firm's ability to meet its liabilities in long run, as and when it falls due. Functions of accounting. Measurement. Accounting measures past performance and depicts its current financial position. Forecasting. Using past performance data, accounting helps in forecasting future performance. Decision making. As discussed under objectives of accounting, accounting aids in decision making of the stakeholders. Comparison and evaluation. Accounting helps in assessing the performance in relation to the targets, commonly known as budgets, and thus helps in predicting, comparing, and evaluating the financial results. Control. Accounting helps to identify weakness in operational system and hence control such weaknesses. Government regulation and taxation. Accounting also provides relevant information to the government and thus helps in collecting tax revenues. Bookkeeping. One who are with commerce background would have definitely learned this subject during 11th and 12th class. I personally loved this subject, being the highest scoring one. Many people confuse bookkeeping with accounting. However, there is a difference between two. Bookkeeping refers to the activity concerned with recording of financial data relating to business operations in a significant and orderly manner. Essential idea behind bookkeeping is maintaining record of each and every transaction and thus show correct picture of each head of income and expenditure. The process of bookkeeping ends with recording. However, as already discussed, accounting as a domain covers along with recording, summarizing, classifying, analyzing, communicating, and many more. Objectives of bookkeeping are as follows. First one is complete recording of transactions. It means bookkeeping is concerned with complete and permanent record of all the transactions to show its financial effect on the business. Next, ascertainment of financial effect on business. It is concerned with combined effect of all the transactions made during the accounting period upon the financial position of the business as a whole. Distinction between accounting and bookkeeping. As noted in earlier slide, bookkeeping and accounting carries differentiating features. Let us have a look at some of them. First, bookkeeping is a process concerned with recording of transactions, whereas accounting is a process concerned with summarizing of recorded transactions. Bookkeeping, through its recorded transactions, constitutes as a base for accounting. However, accounting is considered as a language of business, since through accounting, business speaks its activities, financial position, and so on. Financial statement, which consist of P&L account and balance sheet, including schedules and notes forming part of accounts, do not form part of bookkeeping but accounting. Since the transactions recorded are not presented in a structured format under bookkeeping, managerial decisions cannot be taken using these records. Accounting has many subfields such as financial accounting, management accounting, and so on. We will discuss these subfields in coming segment of the video. Financial position of the business such as liquidity position, solvency position cannot be ascertained based on the bookkeeping but on accounting. Subfields of accounting. As noted, accounting has many subfields. Let us discuss them one by one. Financial accounting. It covers preparation and presentation of financial statements, and communication to the users of account. It is historical in nature, as it records transactions which have already been occurred. The final step of financial accounting is the preparation of profit and loss account and balance sheet. It primarily helps in determination of net result in terms of profit or loss for an accounting period and the financial position as on the given date. Management accounting. To discharge the functions of stewardship, planning, control, and decision making, the management needs variety of information. Management accounting is concerned with grouping information and preparing reports as desired by managers for the purpose of internal reporting to the managers. A very important component of the management accounting is cost accounting, which deals with cost ascertainment and cost control. Cost accounting. It includes preparing periodical statements and reports for ascertaining and controlling cost. Social responsibility accounting. Social responsibility accounting is concerned with accounting for social cost incurred by the enterprise and social benefits created. Human resource accounting. Human resource accounting is an attempt to identify, quantify, and report investments made in human resources of an organization that are not presently accounted for under conventional accounting practice. Users of accounting information. Generally, users of accounts can be classified into two categories: internal management and owners, and external users or outsiders. Management accounting is concerned with identifying information requirements as well as methods of providing such information to management, while information requirements of the outside users are generally served by financial statements. Below are the users of accounting information. Investors. Investors are the one who provide capital to the business. They need information to assess whether to buy, hold, or sell their investment. Also, they are interested to know the ability of the business to survive, prosper, and to pay returns. In non-corporate sector where ownership and management are not essentially separated, the owners are still interested in the performance of the business and its financial position to decide whether to continue or shut down. Employees. Growth of the employees is directly related to the growth of organization, and therefore they are interested to know the stability, continuity, and growth of the enterprise and its ability to provide remuneration, retirement, and other benefits and to enhance employment opportunities. Lenders. They are interested to know about the liquidity position of the business. They are interested to know whether their loan principal and interest will be paid when due. Suppliers and creditors. They are also interested to know the ability of the enterprise to pay their dues. That helps them to decide the credit policy for relevant concern, rates to be charged, and so on. Sometimes they also become interested in long-term continuation of the enterprise if their existence becomes dependent on the survival of that business. Suppose some ancillary units supply their products to a big enterprise. If the big enterprise collapses, the fate of small units also becomes sealed. Customers. Customers are also concerned with the stability and profitability of the enterprise because their functioning is more or less dependent on the supply of goods. Suppose a company produces some chemicals used by pharmaceutical companies and supplies chemicals on 3 months credit. If all of a sudden it faces some trouble and is unable to supply the chemical, the customers will also be in trouble. Government and their agencies. They regulate the functioning of the business enterprises for public good, allocate scarce resources among competing enterprises, control prices, charge excise duties and taxes, and so they have continued interest in the business enterprise. Public. The public at large is interested in the functioning of the enterprise because it may make a substantial contribution to the local economy in many ways, including the number of people employed and their patronage to local suppliers. Management. On the basis of accounts, management determines the effects of their various decisions on the functioning of the enterprise. This helps them to make further managerial decisions. Relationship of accounting with other disciplines. Accounting and economics. Economics is viewed as a science of rational decision making about the use of scarce resources. It is concerned with analysis of efficient use of scarce resources for satisfying human wants. This may be viewed either from the perspective of a single firm or of the country as a whole. On the other hand, accounting is viewed as a system which provides data to the users to permit informed judgment and decisions. Thus, at the macro level, accounting provides the database over which the economic decision models have been developed. Accounting and statistics. The use of statistics in accounting can be appreciated better in the context of the nature of accounting records. Accounting information is very precise. It is exact to the last paisa. But for decision-making purposes, such precision is not necessary, and hence the statistical approximations are sought. In accounts, all values are important individually because they relate to business transactions. As against this, statistic is concerned with the typical value, behavior, or trend over a period of time, or the degree of variation over a series of observations. Therefore, wherever a need arises for only broad generalizations or the average of relationships, statistical methods have to be applied in accounting data. Accounting records generally take a short-term view of events and are confined to a year, while statistical analysis is more useful if a longer view is taken for the purpose. Accounting and mathematics. Knowledge of arithmetic and algebra is a prerequisite for accounting computations and measurement. Calculation of interest and annuity are the example of such fundamental use, while computing depreciation, finding out installment in hire purchase, and installment payment transactions, calculating amount to be set aside for repayment of loan, replacement of asset, and calculating lease rental, mathematical techniques are frequently used. Accounting data are also presented in ratio form. Accounting and law. An economic entity operates within a legal environment. All transactions with suppliers and customers are governed by Contract Act, Sale of Goods Act, Negotiable Instruments Act, etc. The entity itself is created and controlled by laws. However, legal prescription about the accounting system is the product of developments in accounting knowledge. That is, legislation about accounting system cannot be enacted unless there is a corresponding development in accounting discipline. In that way, accounting influences law and is also influenced by law. Accounting and management. A large portion of accounting information is prepared for management decision making. Although management relies on other data sources, accounting data are used as basic source document. In the management team, an accountant is in a better position to understand and use such data. Limitations of accounting. The financial statements are never free from subjectivity factor. as these are largely the outcome of personal judgment of the accountant with regard to the adoption of accounting policies. Some of the limitations of accounting are as follows. The factors which may be relevant in assessing the worth of an enterprise don't find place in the accounts as they cannot be measured in terms of money. The balance sheet cannot reflect the value of certain factors like loyalty and skill of the personnel, which may be the most valuable asset of an enterprise these days. Balance sheet depicts the financial position as on date of preparation of financial statement. Business dynamics change within the time annual reports reach to the ultimate user. To mitigate this, auditors disclose events occurring after the balance sheet date but before approval of financial statements in the financial report. Accounting ignores changes in some money factors like inflation, etc. There are occasions when accounting principles conflict with each other. Certain accounting estimates depend on the sheer personal judgment of the accountant. For example, provision for doubtful debt, method of depreciation adopted, recording certain expenditure as revenue or capital expenditure, selection of method of valuation of inventories, and the list is quite long. This leaves a way for manipulation in accounts. Financial statements considers only those assets which can be expressed in monetary terms. Human resources, although the very important asset of the enterprise, do not find place in balance sheet. Different accounting policies for the treatment of same item adds to the probability of manipulation. Though through various laws and accounting standards, efforts are made to reduce these options to minimum but certainly could not be reduced to one. Role of accountant in the society. Before discussing role of chartered accountant in the society, let us first look at the major areas of service. Maintenance of books of account. For the fulfillment of the twin objective of ascertaining the profit earned or loss suffered and the financial position, it is necessary that all transactions be recorded in a systematic manner, which can be done only by an accountant. Proper maintenance of books of account assists management in planning, decision-making, controlling functions. Statutory audit. Every limited company is required to appoint a chartered accountant or a firm of chartered accountants as their auditor, who are statutorily required to report each year whether, in their opinion, the balance sheet shows a true and fair view of the state of affairs on the balance sheet date and the profit and loss account shows a true and fair view of the profit or loss for the year. Internal audit. It is a management tool whereby an internal auditor thoroughly examines the accounting transactions and also the system according to which these have been recorded, with a view to ensure the management that the accounts are being properly maintained and the system contains adequate safeguards to check any leakage of revenue or misappropriation of property or assets and the operations have been carried out in conformity with the plans of management. Taxation. An accountant can handle taxation matters of a business or a person and he can represent that business or person before tax authorities and settle tax liability under the statute prevailing. He can also assist in avoiding or reducing tax burden by proper planning of tax affairs. Management accounting and consultancy services. Management accountant performs an advisory function. He is largely responsible for internal reporting to the management for planning and controlling current operations, decision making on special matters, and for formulating long range plans. Financial advice. An accountant who knows about finances, taxation, and so on is well placed to help and guide in planning personal financial affairs of an individual. An accountant can render financial advice regarding investment, insurance, business expansion, financial investigations, pension schemes, and so on. Other services such as secretarial work, share registration, company formation, receiverships, liquidation, arbitrations, and many more can be rendered by a accountant. Chartered accountant in industry. A qualified accountant will be able to play an important role in performing important functions of a business relating to accounting, costing, and budgetary control, estimating, and treasury. Chartered accountant in public sector enterprises. The form of accounting followed by public sector corporations or companies is different from that of ordinary accounting. It is the duty of accountants to prepare the accounts and reports of these public corporations in such a way that they enable the general public to know how far the items appearing in various types of records and financial statements justify their existence. Chartered accountant in framing fiscal policies. Accountants have a positive role to play in determination of proper fiscal policies and advancement of trade, commerce, and industry. Chartered accountant and economic growth. In the present times, accountants should conceive their duties as broadly as the conditions might require, and do not restrict them to only literal compliance of the law. Their aim should not be to allow any individual to gain at the cost of the nation. This calls for end of our session. Thank you so much for watching this video till the end. If you found this video to be informative and you gained any learning through this video, do like, share with your friends and subscribe to our channel for more such videos. You can comment below your doubts or queries in comment section. Also let us know your opinion on any other topic which you want us to cover on our channel. Thank you.